What if I told you that $12 trillion more than the entire GDP of China exists in a parallel financial system that regulators can't see? Your pension, your 401, your retirement savings, they're being used as poker chips in the world's largest underground casino. Today, we'll expose how shadow banks transformed retirement security into systemic risk. In this video, we're diving deep into the hidden world of shadow banking. We'll uncover its origins, how it works, the dangers it poses to your nest egg, and what might happen next. If you're invested in any retirement fund, this could change how you view your statements forever. Stick around till the end for practical tips on protecting yourself. Let's get into it. Act 2. Historical context. To really grasp the scale and danger of the shadow banking monster we've created today, we must rewind to its origin story, the charred aftermath of the 2008 global financial crisis. Imagine the scene in late 2008. Lehman Brothers has just filed the largest bankruptcy in US history. Stock markets are in freefall. Credit markets have frozen solid. Trillions of dollars in household wealth, home equity, savings, retirement accounts evaporate almost overnight. The crisis exposed how traditional banks had turned themselves into high-stakes casinos, packaging subprime mortgages into complex securities, leveraging them to the hilt, and betting massively on derivatives tied to housing prices. When the housing bubble burst, the house of cards collapsed, threatening to take the entire global economy with it. Governments and regulators responded with urgency. In the United States, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in July 2010, a sprawling 2,300-plus page law intended to prevent another meltdown. Key provisions included higher capital requirements so banks had bigger cushions against losses, the Volcker Rule, banning proprietary trading banks betting with their own money, stress tests, and living wills for systemically important institutions, creation of the Consumer Financial Protection Bureau and the Financial Stability Oversight Council, FSOC, to spot emerging threats. On paper, it sounded bulletproof. Banks would be safer, speculation curbed, taxpayers protected. But reality had a different plan. Here's the pivotal irony and the true birth of today's shadow banking empire. Dodd-Frank didn't destroy risk, it displaced it. Banks, now shackled by stricter rules on leverage, capital, and activities, didn't abandon profitable but risky behaviors. They simply relocated them to less regulated corners of the financial system. This is regulatory arbitrage in its purest form, finding legal loopholes to achieve the same economic ends with far less scrutiny. The star player in this relocation game? Special Purpose Vehicles, SPVs, also known as Special Purpose Entities or Conduits. These are ring-fenced, bankruptcy remote legal structures created specifically to hold assets off a bank's main balance sheet. Picture a bank taking a bundle of risky loans or mortgage-backed securities, transferring them into an SPV, and having the SPV issue its own notes or commercial paper to investors. The risk stays economically linked to the bank, but it disappears from regulatory reporting and capital calculations. By 2010 to 2012, SPVs were proliferating again, enabling banks to keep expanding credit and leverage without hitting Dodd-Frank tripwires. It's exactly like a dieter hiding calorie-laden snacks in a locked cabinet. The calories still get consumed, but the nutrition tracker never sees them. While banks mastered this shell game, a parallel transformation was underway among the stewards of our retirement security: pension funds, endowments, and insurance companies. Post-crisis, the world's major central banks, led by the Federal Reserve, slashed policy rates to near zero and sometimes negative in Europe and Japan, and unleashed trillions in quantitative easing. The goal? Stimulate borrowing, spending, and recovery. The side effect? Yields on safe assets like U.S. Treasuries, AAA corporates, and high-grade bonds plunged to historic lows, often below inflation rates. For pension funds, this created an existential squeeze. These institutions promised defined benefits, fixed payouts, in retirement, or target returns, often 7 to 8% annually, to match actuarial assumptions. With safe yields near zero, meeting those promises became mathematically impossible without taking more risk. Funds began reaching for yield aggressively, shifting from bonds to equities, venturing into emerging markets, real estate, and crucially, embracing shadow banking channels such as securities lending programs, private debt, hedge fund allocations, and structured credit products. What began as modest experiments morphed into core strategy. This migration was punctuated by several landmark regulatory moments that inadvertently accelerated the shift. 2012. The SEC issued exemptions and rule adjustments for certain investment vehicles, reducing disclosure burdens and allowing money market-like funds and other entities to operate with lighter oversight, effectively handing shadow players more freedom to grow. 2015 to 2016. Post-2008 reforms to money market. Mutual funds floating NAVs for institutional prime funds, liquidity fees, redemption gates were designed to prevent runs. Instead, they pushed short-term funding activity further into unregulated repo, commercial paper, and bilateral lending spaces. September 2019, repo market turmoil, a vivid dress rehearsal for bigger crises. Repo rates normally stable, near the Fed funds rate spiked to 10% intraday as collateral scarcity and year-end balance sheet window dressing collided. Liquidity vanished almost instantly. The Fed injected hundreds of billions in emergency repo operations to stabilize markets. It was a clear signal. The shadow plumbing was fragile, and pension-linked collateral was deeply embedded in it. By 2026, shadow banking, officially termed non-bank financial intermediation, or NBFI, has exploded into a $256.8 trillion global juggernaut, per the Financial Stability Board's December 2025 Global Monitoring Report. That's over half of total global financial assets, growing at roughly double the pace of traditional banking. The U.S. slice alone is enormous, rivaling the GDP of entire continents. Those post-2008 policy choices didn't just plant seeds, they built an entirely parallel financial universe where retirement savings now play a starring and highly exposed role. Act 3. Mechanism Breakdown. With the history clear, let's now dissect the inner workings of this shadow machine layer by layer so you can see precisely how everyday retirement dollars become rocket fuel for hidden speculation. Core engine, the collateral chain. It starts innocently enough. Pension funds, insurance companies, and mutual funds hold enormous portfolios, stocks, government bonds, corporate debt. To boost modest returns in a zero-yield era, they participate in securities lending. They lend these high-quality assets to borrowers, hedge funds, broker-dealers, proprietary trading desks, who post cash or other collateral in return. The lender, your pension, earns a small fee plus reinvestment yield on the cash collateral. That borrowed collateral doesn't sit idle. The borrower immediately uses it in repo markets, selling the securities with an agreement to repurchase them the next day, or term, at a slightly higher price. This generates cheap, short-term funding. The cash from the repo then finances leveraged trades, derivatives positions, interest rate swaps, credit default swaps, structured products, or bets across asset classes. Now the multiplier kicks in. Rehypothecation, the reuse of the same collateral multiple times down the chain. One pension-held treasury bond can be lent out once, used as repo collateral, repledged by the repo counterparty, reused again in derivatives margining. Result, hidden leverage ratios of 10x, 20x, or higher. $1 of conservative pension collateral can underpin tens of dollars in speculative exposure. Analogy. Imagine borrowing against your home to buy a rental property, then borrowing against that rental to buy another, and so on. In good times, rental income covers everything, and you look like a genius. When interest rates rise or tenants vanish, foreclosure dominoes, the liquidity illusion. Shadow assets appear ultra-liquid. Repos settle daily, securities trade in deep markets, derivatives mark to market constantly. But this liquidity is confidence-dependent. In stress, it vanishes. Haircuts on collateral jump, lenders demand more over-collateralization, buyers disappear, forced sales depress prices, creating a downward spiral. 2008 taught us this lesson. Today's larger, more interconnected system makes the potential fallout exponentially worse. Case study deep dive. CalPERS. Consider CalPERS, the California Public Employees Retirement System, the largest U.S. public pension. As of mid-2025, it managed approximately $556.563 billion in assets, delivering an impressive 11.6% return for FY 2024 to 25. But look closer. Private credit now represents to 3.7% of the portfolio, on track toward an 8% target, with heavy direct lending exposure 81% senior debt, rest junior, preferred equity. Their securities lending program, historically tens of billions, feeds directly into the repo collateral chain. Borrowers post cash. CalPERS reinvests it short-term for yield. In calm markets, it adds incremental return. In crisis, if borrowers default, collateral values plummet, or repo lines freeze, CalPERS faces immediate liquidity, pressure, and potential forced sales of core holdings. The 2019 repo episode strained similar programs system-wide. A bigger shock could be devastating. The repo market nerve center. At the heart lies the U.S. repo market. Recent estimates show $12.6 trillion in daily average exposures. Q3 2025 data from the Office of Financial Research, with significant non-centrally cleared bilateral portions. This overnight web connects hedge funds, money market funds, private credit vehicles, and banks in ultra-tight real-time dependency. A single default, margin call, or balance sheet constraint can trigger contagion, unwinds collateral fire, sales higher haircuts, broader freeze. Private credit US. Direct lending now exceeding $1 trillion in many 2025 to 2026 estimates, and hedge funds supercharge this with aggressive strategies. It's not just interconnected, it's wired for rapid, cascading failure. Act 4. Current implications. In 2026, the shadow banking threat is no longer hypothetical. It's actively eroding retirement security. Pension drawdowns in a severe crisis could reach 40–60% based on stress test analogs and current leverage levels, far exceeding 2008 losses for many funds due to higher illiquid alternative exposures. For millions of retirees and near retirees, that means delayed retirement by years, slashed benefits, or reliance on reduced public support. U.S. public pensions still carry a $1.27 trillion aggregate shortfall. Equitable Institute, January 2026 update. Improved slightly from prior years, thanks to strong markets, but shadow-linked vulnerabilities could easily reverse those gains overnight. Regulatory gaps persist. The FSOC monitors trends via annual reports, but $256.8 trillion in global NBFI assets largely evades full oversight, patchy data, cross-border issues, voluntary disclosures. Shadow entities operate without bank-like capital or liquidity mandates. Next, Lehman trigger, private credit funds and interconnected hedge families lead the risk list. Banks hold massive exposures through loans and commitments. A redemption wave or valuation shock could ignite rapid contagion. Personal action steps. Right now, open your 401k IRA or pension statement. Scan for alternative investments, private credit, debt, equity, securities lending revenue line items, high allocations to short-duration, high-yield funds. If alternatives exceed 15–20%, you're exposed. Consider increasing direct U.S. Treasury, TIPS holdings, adding physical gold or gold ETFs as crisis hedges, reducing chase for yield behavior in uncertain times. Following independent sources, FSB reports, OFR data, rather than just fund newsletters. Act 5. Future outlook and conclusion. 3 realistic paths forward. Muddle through, 60% likelihood. Shadow banking keeps expanding. We experience recurring mini-shocks, repo squeezes, fund blow-ups, private credit stress. Central banks intervene repeatedly, rate adjustments, standing facilities, backstops. Pensions suffer temporary 10–25% hits but rebound over 3 to 5 years. The system limps along, growing more fragile with each patch. Systemic collapse, 25% likelihood. A catalyst: major private credit default cascade, hedge fund fire sale, Geopolitical shock ignites, full liquidity freeze, repo market seize. Pension losses hit 40–60%. Credit dries up, recessions deepen globally. Bailouts attempt trillions in support, but fiscal exhaustion and political backlash limit effectiveness. 2008 redux, but larger and faster. Regulatory renaissance, 15% likelihood. Decisive global action, FSB, FSOC, IMF, impose capital, liquidity, transparency rules on systemically important non-banks. Private credit and hedge funds face bank-like oversight. Stability improves, tail risks shrink, but credit becomes costlier, innovation slows, and growth takes a hit. Contrarian viewpoint. The core issue isn't shadow banking per se. It's the regulatory illusion that made traditional banking safe enough to force risk migration underground. By over-constraining banks, we created a less visible, harder to control parallel system. True reform might require rethinking the entire paradigm. Closing reflection, we've constructed a financial architecture where your retirement nest egg simultaneously powers and stands vulnerable to a $256.8 trillion global experiment with critical US-centric exposures, spotlighted around the $12 trillion mark in key markets. The test isn't coming, it's inevitable. The only real question, will we spot the smoke before the fire consumes everything? If this deep dive has you rethinking your portfolio's hidden risks, head to the description for our partner Econopoint's comprehensive guide to building a defensive, shadow-resilient retirement strategy free download linked below. Thank you for sticking with me through this eye-opening journey. If it hit home, like, subscribe, and ring the bell for more unflinching financial exposés. Comment below, do you see shadow banking as an unstoppable evolution, a clear and present danger, or something we can still rein in? Your thoughts matter. Until next time, stay vigilant and protect what you've built. Make the size 3 times of actual.